Coach Facebook, Dave Savage here, and we are here for another Friday Mastermind. Every Friday, 9 o'clock Pacific, we are here to bring value to you guys. So today we have as our special guest, Mr. Dan Rawitch. What's up, Dan?
Hey, Dave.
It's good to have you. And I have as my wingman, Mr. Todd Bookspan. Todd, can you believe it has been 3 years since we've been doing this thing, brother?
You know, it's just crazy. I always say I'm grateful when you called me and said, hey, any interest in starting this little insane productivity thing that morphed into this Mortgage Coach Productivity Mastermind. I'm so grateful I said yes. Thanks for the invite and appreciate you and all your support over this past few years.
Yeah, it was great. So guys, we did hit a milestone this week. We hit 9,000 mortgage professionals in our Facebook group. And the thing I'm most proud of is, yes, we have a lot of super successful people. You know, we brag all the time because we're so proud of the fact that 34% of loan officers that do over 100 loans are part of the Mortgage Coach platform. But, you know, to me, that's valuable. But what's even more valuable is they're the most valuable loan officers in America. They're giving advice. And then if anybody saw the post in today's Facebook group from Scott Nicholson, who we have on today's call, where he said, hey guys, this month, instead of telling everybody how many loans we closed, we all talk about the things we're doing to help our community and the way we're giving back and we're helping people that need it. Scott, dude, that post this morning was inspirational to me. It was, I feel like I've been doing a lot, but I could do better, man. So thank you for that post today, brother. You hear, Scott?
Sorry. Yeah. Hey, no worries. I mean, it's just, you know, we were talking prior to this call. We're blessed to be in this industry. I mean, we're maybe the only industry other than health and safety that's thriving right now. So we're fortunate.
We are, and it is an important industry, guys. We all have jobs. We can have record-breaking success. We can give fiscal stimulus to families through giving them the right refinance, helping them make the right decision. So it's a good time. So we got Tony Blodgett. He's going to be bringing his perspective from the street. What's up, Tony?
Good morning, Dave. Good morning, everybody. Glad to be here.
Good. So Todd, anything you want to say before we bring in Dan and we get his perspective and update? Anything else you want to provide to the community?
You know, I would just throw out there to you guys. I mean, we just talked about it. We're all super blessed to be in this industry and be thriving. And there's just great content out there to share. And so be the light out there. Dave's talked, you know, all this past 12 months about story brand and about, you know, Rene Rodriguez and what he's doing with Amplify, how to tell a story. And you guys have stories to tell. Get out there and share it, right? The community needs to know about forbearance. And then ultimately, you need to be following the people who are putting out great advice. And so I've been following Dan. Every day I'm on his Facebook Lives in the afternoon and watching his market wrap. And so I'm super stoked to be a student for the next 30 minutes while Dan runs us through it. And make sure you guys are bringing that accurate information and get out there and share it because people need to hear from you.
Love that, Todd. And one more person I want to hear from, my partner in business, our president of Mortgage Coach, the man who, you know, leads our product vision. For all you that are using RateWatch and you love RateWatch, Joe, you know, is the product visionary behind that. And for the advice engine and the platform, Joe is here and he is going to do a little 5-minute demo of some new features that we have. So Joe, how you doing, brother?
Great, Dave, and thanks for the whole community for supporting our platform and having these fantastic conversations. I mean, our dedication to helping consumers, especially today, is more important than ever, and it's just fantastic to see so many names of so many great producers helping communities right now gathered here for this conversation. So thanks for being here.
Love it. Yeah, no, thank you, brother. So let me frame Dan Rawitch. I'm not going to go through his resume, but I don't believe there's anyone more well-qualified to provide market insight and update. He's been doing it for the Mortgage Coach platform for more years than I even remember. So Dan, thank you for, you know, just always being that voice of, you know, what's happening in the economy. And then how can we take what we hear and what's happening and be leaders to the families that we serve and to the referral partners that we have. So the first half of this is going to be Dan giving the update he thinks you need to hear right now. It's going to include what's happening with rates, what's happening in the economy, what's happening with real estate. And it's going to include what's happening with advice, because at the end of the day, it's not what you hear, it's what you do with what you hear. So the second half of this call is going to be dedicated to, okay, guys, you heard this update. Now, how are you going to create content that you take back to your families on Facebook, email databases, bomb videos, mortgage coach conversations. What can you do to take what you learned and put it out there and show leadership? So with that said, the one and only Dan Rawitch. What's up, dude?
Hey, Dave, thank you very much. I appreciate that introduction. All right, so can you hear me?
We can hear you, and
Okay.
the stage is yours.
All right, good. I'm going to share my screen real quick. Got a little presentation here for everybody. So, if you have questions, just hang on to them for a little bit, and I guess we'll get to those at the end, Dave. But I'm willing to answer whatever you guys have. So, first, three things. I want to share a little.
Real quick on Q&A. If you're watching this in Facebook, you can put your questions and comments. We will get to them either live on the call or after the recording. And if you're watching this in Zoom, put your questions in chat and we'll get to those for sure.
Thanks, Dave. Okay, so a few things I want to cover. One is what's going on in the stock market. And I know not everybody is totally interested in the stock market, but I think you probably should be, because it's what's on your clients' minds. And not that we should give stock advice. We're not licensed to do that, but I think it's very legal and okay to share your opinion. And so I want to help influence your opinion a little bit. And then I want to talk, of course, a little bit about the bond market, and then what's happening kind of in the legislative, not so much legislative, but just I guess the fiscal policy that's coming down toward the mortgage industry. And then most importantly, some thoughts I have on the home buying market, which I think, before I put this together, if a friend asked me, should I buy a house right now? I'd have said, why don't you hold off a little bit? Let's just see how big this dip is. After putting this data together, I feel 100% different about that opinion. I actually, if I were thinking about a home, I would actually buy a home right now. I mean that, and I think when you see this data, you'll probably agree with me. So let's start with the stock market. This is just one example. There's so much data we use to make decisions, on a daily basis. And a lot of people saw my Facebook post where I did a video talking about it's too early. Don't jump in yet. The media had all these headlines about shortest bear market in history. The bull is back. It honestly makes me want to barf. These talking heads on CNBC, the stuff they come up with. And so, data is our friend, and here's some good data. So there's a bunch of different models we use, and these models are used to decide how much should I have in cash and how much should I have in the markets. And I have never seen every model that I look at telling me to be 100% in cash. This is overwhelmingly telling you, you do not want to buy stocks right now. You just don't. And I don't care what anybody says. I don't care. Sure, Apple looks good today. It's going to look better next year. I'm sure there'll be some winners, but you just want to be careful. So this is really compelling. And you can see here, this line now has dropped down. It's right here below 2008, below the crash of 2000, well below any other thing that we've seen since Great Depression. That's pretty good data in my opinion. And when you take this data, then we said, okay, so that number I showed you, the number we measure is when the sentiment gets below 40. That's when it gets sort of ugly. And with that said, then you say, okay, throughout history, how many times has sentiment gotten below 45 for the first time in a 200-day period? And so from 68 to 2020, these are the times that it happened. And some of these numbers are so incredibly awful. You can see going 2 months out, all the way back to 1973 in this case, only one time did you have a positive experience in the stock market. That was 1980. Going out 6 months, only one time again. Again, that was 1980. Going out 1 year, only 2 times. So, and you can see the risk reward is just so out of whack. So there's a lot more room for this to fall, but a lot of money can be made. I mean, one of my newsletter readers yesterday said to me, and this is why I actually decided to share this. He said, I haven't really been following you as closely, but I do read your newsletter, and you made this great point, and I bought shares in VXX. VXX is a symbol you can buy when the stock market is going down. It blows up, And he said he turned $30,000 into $110,000 with that one investment. And that made me feel so good. But then he said, so now I want to put it in Apple. What do you think? And I said, that's what I think. You can't do it. So keep that in mind. Okay, next, Treasuries. So we know the Treasuries got ahead of themselves. And I told everybody, relax. Anytime you have a parabolic decrease like this, you're going to bounce back. These rainbow numbers are Fibonacci. And Fibonacci is just magic numbers. I won't go into all the detail there. But we measure from the top to the bottom, that's 100% drop. And then each of these lines, so this 38.2, that's percent bounce back. And so the stopping points are always going to be, the first level is going to be 23.6, then 38.2, then 50%. Once you cross 50%, it's a safe bet you're going to go all the way back to 100. But we're stalled out at the 78.6 Fibonacci level. So it's becoming concerning. We've tested this many times. I don't think that we crash down by any stretch, but there's some things that we should be concerned with. So I think you're going to see some softening in Treasuries coming up here. Thing number one is, my favorite indicator here is the smart money. And smart money is just slowly dripping out of here. It's real subtle. Volume is slowly bleeding off. So it's like, how do I want to say that? It's basically the plane is losing altitude. And then that's it. Okay. And then this indicator right here, rather than going into all the detail, when you get a 9-bar movement in any positive move, that's big. Bar number 9 just happened, and we lost some velocity here. So just be a little careful on Treasuries. And then using sentiment, and sentiment is something that people don't pay enough attention to. Some people joke with me like, why are you always such a contrarian? Well, because that's the only way you can win in the markets. And what I mean by that is, so this is, the lower here is a sentiment reader. Call it optics. It's really an optimism. How good are people feeling? Up here is price. And anytime people feel too good, and if I went over here, so this is, oh, you can't see my other screen, sorry. Uh-oh, internet connection unstable. Hope it's okay. So when sentiment got too high, look what happened. There was a fierce drop in price, and that was that huge, that was this. That happened because sentiment was too good. When sentiment gets too bad, and that was the bottom of that last move, the market's going to go back up. Sentiment's a little too good right now. So it's not at 100 yet, but you know, we're getting close to there. So I would just say Treasuries are just a little bit overcooked right now. The Fed is here. There is no fear, so it can't go very far. We put a lot of trades on in the last couple of days that are basically range trades. They make money if the market stays at a certain range. And I know this Fed's in there, so I know that we're going to be supported to a certain extent. So the Fed is your friend when it comes to Treasury. I don't want you to worry, but you could see some dips. All right, let's talk about what's going on in the world. And again, I'm not here to be a doomsdayer, actually just the opposite. But if you don't face the brutal facts, then you really can't combat anything. If you just go, oh, life is so good, rainbows and butterflies. Look, it's not, we know that. But if we face the brutal facts, then we can attack it and we can win. So first of all, Redwood Trust, I don't know how many, I think most people know Redwood Trust. They're a big buyer of jumbo loans. They're a quality company. They've been around forever, based in Marin County, California. Their margin calls have been so extreme that they're selling off huge assets at huge discounts, like 30, 40%, just whacking whatever they can to make margin calls. They're on the ropes. Mortgage banks overall have been stunned with margin calls. And so people say, well, how's that happen? Well, if you have a pipeline of, let's say, 100 million and you're a capital markets guy, you can't hedge the whole thing because not all the loans ever cut, right? Is your pull through ever 100% locked to closing? No, it's not. So with that in mind, you look at your data and you say, well, what is my average pull through? Let's just say it's 70% locked to closing. Well, that means on a $100 million pipeline, I've hedged 70 million. Because if I hedge the other 30 million, I'm spending money on a hedge and I'm just going to lose it because I don't have the asset. Guess what happens when rates did what they did? 100% of those loans are delivered. Now, all of a sudden, I've got $30 million of unhedged loans that are 5-6 points underwater. Do the math, guys. There's your 18, 19, $100 million margin call. Bigger they are, the harder the margin calls hit them. So you got to know that, and it's going to work itself through. There may be some smaller lenders that don't make it. And then haircut increases. Haircuts are, if I fund a loan, let's say it's a $100,000 loan, a haircut is how much is my warehouse bank going to advance me. So a typical haircut might be 2%. So I'm gonna fund 2,000 of that, and my warehouse bank's gonna fund 98. I get my 2% back when the loan's off my line. It's like collateral. Haircuts jump to 10%. So now I got a margin call and my warehouse bank saying, hey, you gotta write a check also because I'm haircutting you deeper. And then we have clog lines. All of this is temporary. We've been through this before. This gets better. More MSR values are plunging. Mortgage servicing rights, and that's due to prepayment speed assumptions. If I'm buying servicing, and let's say there's a 1/4 point spread in that servicing, and I pay let's say 1.5 points for that servicing. If it doesn't stay on the books for 6 years, I lose money. I need the servicing to stick around. When rates drop like they have, prepayment speeds go through the roof, servicing values plunge. It's kind of dumb if you think about it, because the loans that are being made at, let's say, 2.5%, they are not your risky loans. Somebody needs to come up with an analysis that says prepayment speeds on my old stuff is worth it. You can't sell a coupon over 4 or 5% for a while, but the new stuff is what you should be wanting to load up on. But that is kind of the way it works. All right, bond prices are fantastic. I think they're going to stay that way a long time. The Fed clearly wants and needs to drive interest rates to zero across the yield curve. That does not mean zero mortgage rates, because we have to add on things before it gets to the borrower. The servicer has to get paid. The mortgage bank has to get paid. All these things are add-ons to the Fed funds or to the Treasuries. So, but I really think we're going to see 2.5% 30-year fixed before we even know it. It's going to come. Estimates of over 2 million homeowners are going to request forbearance. But I personally use that as a selling point, because what it says is the government is here. Look, I'm opposite of a socialist, but times like this, we're all socialists. Uncle Sam is going to prop up the country. End of story. So if I'm talking to a buyer and they're hesitant, I say, look, if things get really crappy, you're not going to have to make your payment. You're just not. So the new deal is HUD just released a plan that says servicers will offer a 6-month forbearance, and then if they request, the servicer has to give them another 6 months. So what's missing right now is, how about the servicers? The servicers now, they're not getting a payment, but they have to advance the payment to the bondholder. That's their job. They collect the payment from the borrower, and then they pay the bondholders. If they don't get a payment from the borrower, how are they going to pay the bondholders? That's going to create a cash crunch. The Fed is just about to release something, but yesterday we got a little bit of bad news. I'll share that article with you. But anyway, the bottom line here, you're going to see liquidity issues and weaker profitability in mortgage banks for the next 12 months or so. That might create some price wars, et cetera. It might thin some of your margins. It might take down some of your comp plans. But guys, you're going to be talking about more volume than we've ever seen in our lives. I mean, a number so far greater than you can imagine is coming. You got to hang on. What do I do with that one? I guess it's the next slide. So these were the non-farm payroll. This goes back to the Great Depression. Today we lost 700,000 jobs. That's not the worst we've ever had. The worst we ever had was minus 2,000 jobs, and that was back way here, 1939. So look, I do think it's going to get bad. I don't know if it's going to get as bad as it was during the Great Depression, but there's going to be clearly a lot more jobs lost. And that's why I think, well, I'll get into that part in a minute, but borrowers are going to need to refi, and they're going to need to get debt consolidation loans. So this really bummed me out yesterday. U.S. Holds off on extending virus aid to mortgage servicers, but the headline is really misleading. And if you really read this, what they're saying is they discussed holding off, setting up such a program to see if other policies put in place recently will help their liquidity shortfalls. So they have other things that they can tap on. But it's dumb. Like, the forbearance alone is creating the need for the servicers to get bailed out. The country has been 100% clear on this. The mortgage business cannot cease. It's never ceased. It will not cease. And we're going to do whatever we can to prop it up. I'm not worried at all. It's just time. It's just getting through this. And while you're waiting, look, you're still in business. People are telling me, like, I got a pipeline for the 40 loans. They're not locked. Should I even be writing any more loans? I'm like, oh my God, what's in your pipeline has nothing to do with what can be in your pipeline tomorrow. Never assume that a no-cost loan is the right loan for your borrower. This has annoyed me for many years. I'm old school, but the new breed of loan officers, in some ways, they just don't get it. And in my opinion, Mortgage Coach, the advice engine, it exists for this reason. If you're going to be in the house for more than 7 years, why would you do a no-point loan? Because 7 years, actually, in some cases, the break even is 4.5 years, depending on how much you pay. But if you know you're going to be in a loan for 10 or 15 years, why not buy down and get a 2% 30-year fixed? Why not? You can add it to the loan balance. Now, I get on a purchase, it's a little bit different. They might not have the capital, but I think Scott Nicholson can address that one, because that capital can certainly come from the sellers. But look, the only thing that's stopping you right now is because it's like, I need to do a no-cost loan for the borrower. No, you don't need to do a no-cost loan for the borrower. You might need to do a no-cost loan for the borrowers in your pipeline, but what you need to do right now, I would do a daily video, a short one, and I would say, Mr. Borrower, I know we're holding off. Here's some quick updates. I'm doing Facebook Live every day. You can take my content. I'll update you tomorrow. These no-cost loans are coming back. Meanwhile, every time your phone rings, forget about what you had yesterday. I remember when I first got in the business, 1978, I was selling government loans, and they start going up and up and up. And I remember 1979, all of a sudden, FHA loans hit 12%. And realtors were like, and I remember saying to my boss, I was like, man, it's tough out there. These rates are tough. And my boss said, oh, so you decided to have a bad year? I was like, what? Why are you saying that? Well, because you've decided rates aren't good because somebody told you they're not good. Write off your year. You're done. Go home. And it was so true. I said, you know what? Nobody knows that they were 11% yesterday. We know that. They don't know that. Sell the 12%. They need the house. And anybody that took that 12%, back in 79, they're happily retired with a zero mortgage balance. So you got to take each new phone call as if these freakishly low rates from a couple weeks ago never happened. Just erase it from your head. It didn't exist. It didn't happen. Don't apologize for today's rates. People are going to be hungry for debt consolidations. They're going to be hungry to save money. Now, this next one is very near and dear to my heart because people think, well, wait, you're the rate watch guy. Why shouldn't I float? Because you're telling me when I should lock. I don't want that to be my purpose. I want my purpose to be to help you get people to lock, to help people that are on the fence, to get them to move. Because floating loans, forgive me guys, but it's a fool's game. You talk to any really huge producer, get Jeremy Forcier on here right now. Get him here right now. The guy will not take a loan app if the borrower's not going to lock. He's too busy. Because you're kind of like playing with yourself. You're like, it's in my pipeline, so I'll close 80% of my pipeline. And then, no, you can't do that. If they don't want to lock, what you're having to do is you're having to sell them every single month, every single day. You got to tell them again what the rate is. Tell them again. Tell them again. You get so busy telling 30 people what the rate is, it starts draining your spirit. And then when the phone call comes in, you don't want to take it because you're too busy babysitting the ones that won't lock. If a borrower doesn't want to lock, let them go waste somebody else's time. I know that's severe. I know that most of you aren't taught that way. But if you want to be a mega producer, you lock a loan when it comes in. How happy would you be right now if you would have done that? And you're going to get another opportunity, I promise you. And by the way, you don't get paid for times at bat. Times at bat to me is an application. You don't get paid for those. You get paid when you lock a loan. That's a base hit. That's a home run. All right. real quick, because we talked about the Fed funds rate and going to zero and Treasuries going to zero, that doesn't mean mortgage rates go to zero. There is a historic spread between mortgage rates, this 30-year fixed rate loan, and Fed funds. And you can see sometimes that spread has been as high as 4%, but historically it's about 2.5%. And that's why I think we're going to see 2.5% 30-year fixed, just based on this graph right here. All right, let's talk about real estate. So these are the average home prices from 2008. If you bought at the very peak here, you were a little bit bummed out, but guess what? You lost. This is a national figure. I know that every town's got a different story. Some towns were more severe, some were less severe. Dallas, Texas, I don't even think they knew that there was a meltdown. They just kept going. This is $30,000 from peak to worst. And then you could say, well, gosh, it sure took a long time to get that money back. It really didn't take that much time to get it back. And I'll show you in a minute, you'll see why that time was well spent had you bought here instead of here. This is listing inventory. Down, 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 down. I always said I will never buy anything if there's a bidding war, ever, because that's just dumb. That's my business school 101, very first business class I ever took. He said to me, the mass is always wrong. Follow the mass, go broke. Well, the mass is out there bidding on houses, overpaying for houses. Mr. Homebuyer, if you want to be that dumb and wait again until this inventory goes down, because here's what's going to happen. This is just Feb. March and April, you're going to see inventory go way back up to these levels. No more bidding wars. Getting able to make an offer and have it stick. Getting the seller to pay some costs. That's when it's fun to buy a home. This is not fun. Talk to any of your buyers. They didn't enjoy this. I was a real estate agent one time. It's not fun when you have bidding wars. Rental prices. Look at what's happened. So while home prices were going in the toilet, rental prices just kept going up and up and up. Now about here, as you know, home prices started going up as well. Rental prices will not stop rising, in my personal opinion. We may see a dip, but look, they've been going up every single year, and this starts nationally. Back in 2010, they were about 1,300, and now they're about 1,600. That is a huge increase. Mr. Buyer, if you could lock in a 30-year fixed rate right now at 3.5% and know that it will never, ever, ever go up as long as you live, does that look a little better than this picture? So you're selling the inventory. It's going to come up. It's going to be less of a bidding war. You're creating urgency because if they wait, they're going to be back in the bidding wars because inventory is going to drop back down. Meanwhile, as you wait to buy a home, rental prices are continuing to go up. This is price increases. I just randomly took these cities. Now, I could always predict, this is kind of a duh statement, but not enough people look at it. Back in 2018, I told most people that you're going to see a dip in real estate prices. And I was right. So because I just watched these numbers and what you can see here. So most of these little bars are annual, going back to 2009. You can see that listing prices just continued to go up for a while. And then, I'm sorry, this is the percentage of homes that had an increase in the listing prices. So then less is good in this case. Well, look, this is the last, this is October of 19 to December of 19. It flattened. So we're not seeing home price listings being increased, but they're no longer, the number's not going down. When it flattens, it goes up. That's just historically what's happened. So a lot of markets, this is just evidence to me. Even if this this meltdown didn't happen, I think you'd start seeing more price increases, less of them. So I just think it was going to level off anyway. That's the point of that slide. Okay, now I did I'm not good at these. I did a mortgage coach advice engine. I did two. I did a rent versus own, and I did a cost of waiting. And this is where Scott or Tony can jump in and tell me what a bad job I did. But guys, this data is so powerful. All right, so number one, this is right in the advice engine. Just go in. I never used the new software. I happen to have an account because Jacob gave me one so I could post rate watch. I've never done this. Well, I've done it, but not for 10 years. So rent, I took the national average of a home based on the data I just showed you. And what you can see here is if you buy a home, I use a 3 3/4 30-year fix. I think you can get that. Total payment is $1,558. Rent is $1,620. Right off the bat, why do you want to do this? Now, the $1,558, you're paying down, you're increasing your net worth by $368 every single month. So your net payment is $430 better if you buy a home. I think that's kind of a huge point. And there's over 60 months, you have a choice. You can either pay $103,000 in rent, or you can pay down your principal by $24,000. The way I see that, it's $127,000 swing to own, right? Now, what if prices dip? What if it takes 5 years for them to come back? So what? You're still ahead by $127,000. I guarantee you prices are not going to dip that much. This is rent paid versus your mortgage, personal paid down over 15 years. You want to pay $360,000 in rent for the next 15 years? You want to wait for the bottom? You want to try to get lucky and see if you catch the bottom? A friend once told me, take a picture of a tennis ball as it's hitting it hits the ground, and as it reaches the apex of its height, snap that picture before it goes down. It's impossible. That's what I feel like catching the market. I'm a trader. We don't try to catch bottoms. It's dumb. But in 30 years, 15 years, you could be 88,000 richer or $360,000 poorer. Sorry, then I got one more to show you. And this is cost of waiting because maybe, oh shoot. Hang on, sorry guys. I have to shrink this. I should have just made a link.
So guys, while Dan is putting this together, it has never, two things you guys need to do from a leadership perspective, because we're going to transition in a few minutes on how do you create content to be a leader. And you need to do two things. One, you need to be bringing news, what's happening in the market, and creating content around that. And the internet is full of that. I follow a lot of loan officers. Everybody's doing a great job on that. But Dan's making a great point here. What else do you need to do? You need to be a mortgage advisor. And that means people are coming to you thinking one thing. And after you asking them questions, and after you giving them a total cost analysis, they're like, I hadn't thought of it that way before. Guys, that's how you can build your brand in this market, by making sense of what's happening in the news, and then telling stories where, hey, a family came to me, they were confused, I answered their questions, and this is what they did. I don't see nearly enough of that content in the market. So Dan, you're killing it. We'll bring in the rest of the queue in a few minutes. You ready to walk us through this? It's a cost of waiting total cost analysis. Cool. Let's check it out.
Yep. So again, there's probably a better way to use the product. I went in just cold, not knowing how to use it. So what I did is I took a purchase price today at 400,000, and then I said, what if you wait? Maybe it goes to 370, because that was the dip that happened in 08 in most markets. I said, now you can get 2 7/8. Now I get it. You have to pay some points, but we're talking about a buyer that's going to stick around. We're even going to pack the points into this loan amount. So, and then I looked at where was the rate 18 months ago. It was 4 3/4. So the payment now, if you do it now at the higher purchase price is $1,850. If you wait, yeah, you'll have a lower loan balance, but you'll have a higher payment. Huh? Like, what are you really buying? Car dealers proved that to us a long time ago. How many of you can really afford the $90,000 Tesla you're driving around? None of you, probably. I mean, realistically, would you write a check right now for 90 grand? Probably not, but you sure will make a $1,200 lease payment. It's the same thing. Do you really care what the house costs? No, you care what it costs you every month. And in the end, this is what you win. Monthly savings of $234. The payment difference there, savings over 60 months, $25,000. And that's after paying more for the house with a lower rate. Interest over 15 years, that's a $71,000 difference. You can't, the prices are not going to fall that much. They're just not. So that's kind of my story. I think I might have one more slide here. Yeah, I do. Well, yeah, I got to sell something, of course. releasing a new product, and well, I'm kind of excited about it. It's called Market Mentor. You'll get 2 to 3 live daily market updates from me, similar to this, video and or written. I don't think this has been done before, but I'm going to monitor a chat room in real time during the day. So you can bring your questions from the field or whatever. Can I guarantee instant answer all day long? No, probably not, because I'm a trader. But because I'm a trader, I'm always staring at my screen, and it takes me a second to jump in and answer, maybe redirect. You guys will get a chance to talk to each other about what's going on, share your own ideas. You'll get a monthly market newsletter. You'll get weekly chart classes, like really how to understand the intricacies of a chart. My hot monthly stock pick, I'm always kind of stalking a stock to see which one looks hot to me, and all that for the low price of $17. I'm calling that the founding member rate. And so here's a link if you want it. I don't know if Dave, should I put that somewhere, but for now I'm done. You can tell me what to do with the link.
All right, three things. So Dan, first of all, I am going to be in your mortgage mentor program. So great job on that. Do put a link down below, Robert or someone on the team, put a link to Dan's thing. And Dan, I just can't thank you enough for all the value, you bring into the mortgage coach community, the daily, updates, the lives. And then, I hope you do great with this. I think every loan officer should tune in and have, 24/7 access to you. So cool on that. Dan, if you could stop sharing your screen real quick. So 2 questions before I bring in the other folks on the call. One, do you have a hard stop? Can we go over on today's call? Because there's a lot of engagement and I can see the questions. This call is going to go longer than an hour. Can you stay on the call?
Me?
Yeah.
Yes.
Dan.
Yeah. Did I go overtime?
No, dude, I don't care about that. I just can tell right now that between the questions, I have questions. I know what we have planned to share. This call is going to go more than another 20 minutes. So folks, if you're on this call right now, Dan and I, other people may need to leave, but Dan and I will stay on the call and answer your questions. So bring them into the Facebook chat, bring them into Zoom. So before we
I have
start,
one good idea. Sorry, just in terms of time, maybe don't let Scott talk, and then we'll have plenty of time.
Okay, well,
Just
we're gonna.
kidding. Just kidding. I love Scott.
That is a good idea.
My brother.
Yeah. All right. So guys, before we start asking questions of Dan, we want to show you something that we've done within our advice engine. Now at Mortgage Coach, our goal is to power you with the best advice and information so that you can tell a family or a realtor or anybody, my advice makes a difference, and then you can show it. It's not just a statement. It's you can say it, and then you can show it, and you can bring value. So we're always looking for ways to upgrade our Rate Watch app, upgrade our total cost analysis app, update our advice engine. So Joe Patur is going to step in, and he's going to show you a new index that we're adding. And Joe, I don't know if you intend to put on your camera, but yep, there you are. Why don't you tell people what we did and why we did it?
Yeah, absolutely. So as everybody knows, and as we've learned quite a bit on this call, when you have the right information that can be shared in the right context, you can make a world of difference for your borrowers and partners. We have a partner, Optimal Blue, who put a lot of work into creating some indices to help the market. So for those of you obviously familiar with Rate Watch, coming out in just a week or so, you'll see a new option where it says Mortgage Market Indices. You'll also find in the typical lenders tab that has powered data from Optimal Blue for quite some time, you also have a link to these indices. And what Optimal Blue has done is they have about 30% of the locks that occur in mortgage transactions today. When you look at of those 30%, about 80% of those are independent mortgage lenders, and another 20% are banks and credit unions. And they have taken that lock data and created 3 or so views that you can use in your conversations. So they break down different loan product types by the average rates over a 30-day range. They show different buckets of credit scores that have both a low LTV and a high LTV reflection of data. So you're able to see the average rates for these brackets of consumers based on these intervals of credit worthiness. And then you're able to also see this information with some trend data where you can see a 30, 90, 180, or even a yearly view when you're looking at this lock data that Optimal Blue is capturing. Much like the other screens within the RateWatch experience, if you're trying to have a contextual conversation about the difference in rate at these different market segments, you can click share and you could post it, you could email it, or you could even text message it to share the content that's here. Now, we also know how important it is while you're working in the advice engine to have this information for the conversations at hand. So at Mortgage Coach, as we've built out the advice engine solution, we have a toolbox, which many folks hadn't noticed that there's a gear here that lets you add different components to the view that we think are both important and relevant. And you'll begin seeing quite a bit of content, not just our interviews and commentary from Dan, but even content from your own lenders is going to be able to populate that space. But one of the new tools is the same indice data that I showed. So within the advice engine, you can see these average rates. You can see the breakdown of rates by score, and you can see the trend data that Optimal Blue is sharing and publishing. So we think that this information, again, is incredibly relevant in the market that we're in, and we've simply made it easy for you to see and discuss through our multiple interfaces of RateWatch and the advice engine. And so knowing the types of conversations that you have to have in the market, and we have obviously a number of top producers on our panel and here in the audience, I'd love to hear any feedback about how our community of originators could use this type of insight in their conversations, but we certainly thought that it was worthy of spending some time to develop a way for you to both see it and share it. So Dave, Dan, I don't know if you have any comments on this new data that's available for our team here.
So I'll go down the list. Dan, you want to go first? Any thoughts on the data or how we've integrated it into the platform?
I love it. It's going to make my life easier because when I jump on Facebook Live, I don't have this data. I'm always scrambling around trying to find out what's happening.
Love that. Dan, your internet is going in and out. At least I think it's Dan, not me. Tony, what about you? Any thoughts you have on this new integration?
Yeah, absolutely. I was fortunate enough to review it yesterday a little bit ahead of time and went through the whole slide deck and white paper that Optimal Blue put out. We are an Optimal Blue user, so I'm very familiar with the technology. But I think, you know, having this information that's so relevant to what our peer competitors are doing can be really helpful to a loan officer. I think that, you know, all we can see is our rate sheet, and not having access to what the market is doing, generally speaking, can sometimes, you know, put us in a vacuum. And so at least knowing what's out there and having a tool that you can share. So many of us, the only place we have to go look is like a bankrate.com or somewhere that's like an online type of a service where we can try to figure out what we think our customers are seeing. And to me, that's like 20 years ago when I got in the mortgage business, and we would look at the Sunday paper to see what rates are doing. Look, the reality is we all know that those are like advertisements. Those are just, you know, the lowest rate available, that maybe they have a few of those they can offer you, and it's to make the phone ring, and it's a lot of online lenders. And so I like the fact that this is some real-time data with peer competitors so that we can get a level of confidence in what it is that we're doing as retail loan officers, see what our peer competitors are doing, because that's what you're going to find in Optimal Blue. And I also like how it breaks up differences based on loan to value. I could really see a lot of value in that when you're speaking to a client to help them understand why they may not be getting the very best rate that they heard was available. Because when you look at it based on, say, credit score or LTV, we all know that these factors impact the rate. But to be able to show them that in a graph and say, hey, this is what, you know, this is kind of a survey of 35% of other mortgage companies, you can see these same differences. And if you were to put more down, you could get that better rate. And so I think there's some other tools within this that you could use to help you sell at different times. Just very similar to the way that I use, you know, Daywatch or the RateWatch app to explain certain things. I think it's a matter of figuring out, getting comfortable with the tool, identifying the aspects of it that are going to help you present the certain situation that you're dealing with based on that customer. And I'm really excited about it, to be honest with you, Dave. So yeah, thank you guys for integrating that.
Yeah, no, thank you for the perspective. And community, we want to hear from you. This is something that we're going to launch next week, possibly, could be the following week, but within the next 2 weeks, this will show up in your Rate Watch app. This will show up in the advice engine. And we want to hear from you. How is it valuable? Scott Nicholson, any thoughts from you? Anything you?
Yeah. I mean, Tony made some great points. And the one thing I immediately focused on is, Joe, if you can click on the credit to LTV. So I plan to share this a lot, just doing screen captures and sharing this to my real estate agents and consumers. In particular, what Tony was saying is a lot of people don't realize that let me rephrase this. Think about the consumer who's exiting this market once the virus is over. Do you think they're coming in with higher or lower FICO scores? Lower, because they're going to be bringing on more credit card debt. And they're going to be coming out of this with higher ratios, lower credit, and not only that, probably a lot less money because they're bleeding through reserves or don't have the confidence to put everything they have into the housing market. So they're bleeding through their down payment, we'll call it. And so one of the things I focus on, and you know me, I'm the seller buy down guy, is when I do a screenshot of this and I show the consumer who's on the far right putting the 20% down that came in pre-virus, their rate was 3 3/8. Now they're exiting this, and now I got to be quoting them a half point to 3 points high, or 3/4 of a point higher. How are we going to do? And I'll get into this later. This was part of my segment. By using the seller buy down to take them from the far left and deliver them a rate that could be on the far right, and deal with the lower credit score they're going to have, and dealing with the lower down payment they either have or want to invest in the market. This is a critical piece to show your agents and how credit and LTV impacts the rate they're going to get.
Yeah, love it, guys. So I love this thing for a lot of reasons. You know, we obviously agreed and we put it into the platform, but think of it like this. You know, when you want to know what the weather is, there's a lot of different weather channels, weather.com, underground weather, you know, there's a lot. And now in the mortgage industry, think of this as like a thermometer of where rates are at in the industry. And the beauty about this one is it's rate locks. It's loans that are actually getting locked in and getting done. They're not advertisements. So if you want to know what's being advertised, you can go to Zillow, you can go to Bankrate, you can go to a lot of places. You don't want to know what's getting locked. You guys, the industry has a thermometer. It's here. It's integrated into the mortgage advice platform. So it's valuable for you. Because I always believe that presenting data is important to the family, but understanding it yourself is where it starts. It starts with you. So we're making you smarter. We're making you more informed. And then we're giving you something that you can present in a tailored way. When it makes sense, tailor it in the market and put it out there. Dan, before we move into, you know, economic Q&A and marketing leadership on how to create content and promote it, anything else you want to say about this innovation?
No, I think I broke up, but just to me, it's going to help me so much in just what I'm talking to you guys about. This data is priceless. I love it. That's all I got.
All right. So Joe, if you could stop sharing unless there's something else you want to show.
We'll certainly show quite a bit more. As everyone knows, we do a release almost every month. So looking forward to some of the other things that we have ahead, Dave, but I'll turn it back to you.
All right, cool. So stop sharing. If you want to be on video, jump on video. So I'm going to say we're going to go, you know, to 10:15. And if we need to push it, from Q&A, we'll do that. Tony or Scott, do either of you guys need to leave before that? Can you stay on for an extra 15 minutes?
I'm good.
Okay. So before we start, you know, like sharing strategies and ideas, does anybody have a clarifying question for Dan? You know, something that he said in economic data that you want to get clarification on? Any questions for Dan?
I have 2 questions for Dan, if you don't mind.
I do. I do not.
Dan, you talked about the stock market at the beginning, and I got to say, first of all, your presentation, I follow you every single day, and that was one of the most concise, just, you know, talks that I've seen you do. All the things you hit on are so relevant, and I couldn't agree more with everything that you said this morning. So I want to put you on the spot a little bit about the S&P 500. We've had some, and I've asked you this on Facebook, so I want to see if you have a current prediction today. I know, you know, I had kind of thought that 2,400 level we hit back in December of 18 was a good level. And now there's been talk down at like 1,800 or 1,810, you might have said last time I heard. And do you have a current prediction based on where things are today? Because I think there are a lot of people who have been in cash. People that follow you have known that this is coming, you know, and you know, may have been investing at the fringes, but are probably not all in long in the stock market if they've been smart with their money. But, you know, there may be opportunities for that. Can you give us any prediction there? And then I'll just throw them both out there. If you could touch on what's going on in the jumbo market in your perspective. We all saw Wells Fargo dropped out yesterday. I'm hearing possibly Chase. You know, so it sounds like on the correspondent side, you know, maybe jumbo is going to take up, you know, go away for a little while. Do you have any perspective on that?
Yeah, thanks, Tony. I appreciate the compliment. So first thing that has to happen is the S&P has to go down and test that low from, you know, the initial drop. Actually, let me just pull up a screen real quick. It's sometimes a picture's worth 1,000 words. Ah, sorry. Hang on, guys. Here we go. All right. So, oops, that's a 5-minute chart. Bring up the day chart. So this will be tested absolutely 100%, no doubt. What happened from here to here, again, call this 100%, and then the retracement got to a typical classic Fibonacci second level test of 38.2, and it has now failed 1, 2, 3, 4 times, gap down. It's going to consolidate here a little bit because you can see these blue bars. These are like.
Hey Dan, we can't see your screen.
Oh crap! Thank you. I did the first part. I brought the thing over.
Thank you, Tony. And then Joe, if there's any chance, we've got 48 comments in our Facebook group. I'll moderate Zoom. Could you help me moderate the comments coming in on Facebook?
Sure.
Okay. So what I was saying, let me move this out of the way. So the initial drop, you know, here everybody thought, oh my gosh, the world was ending. It was. Then you got suckered back in here. This is classic of every single bear market I've ever seen, and I've seen a lot of them. And then, boom. So a classic retracement is second level Fibonacci, which is a 38.2% retracement. So we failed here. We failed here several times, and now we've gapped down. So the next stop, it's going to consolidate a little bit right in this level. The next stop is a retest of this, what is this, 2220-ish? It's not going to hold. It might hold for a little bit, and you might get another retracement, but most likely it comes through here. And the next stopping point from there is 2100. Next stopping point from there is about 1800. And so what you have to ask yourself is, are these three things resolved? Number one, do we have a fiscal policy our monetary policy that's working? Yeah, kind of. But if you pull the Fed out right now, you're dead. So still a iffy there. Number two, do we have a monetary policy that's working? Do people feel like they're going to stay afloat? Kind of, but Congress already talking about needing another package. Number three, and the most important one, is the virus contained? Until the virus is contained, nobody knows when companies open back up again. And until we know when companies open back up again, we can't forecast their earnings. We value stock based on a multiple of their earnings. So if I don't know what your earnings are, I'm going to think the worst and I'm just going to cream it. And so that's what's going to happen. The opportunities are going to be massive. Like I think Hertz rental car right now is down to $4. Avis is down to like $10. Granted, I'm short both of those. We'll ride them down for a while longer, but the opportunities will be huge. Don't jump back in yet because you can get pretty wealthy if you wait. And then the jumbo thing. So I think you guys know this. Jumbo loans are securitized, or they're just sold to a Redwood Trust or somebody like that. I started the call by talking about the problems with Redwood Trust. That's any single person that's going to package jumbo loans and sell them in the securities market. They're not going to get rated. Fitch, Moody's, Standard & Poor's, if they get rated, they're going to rate them as junk. What's the point of trying to go out with a 4% mortgage bond with a rating of, you know, BB or something? So they have to pull back until the default concerns go away. The big banks, Wells, B of A, et cetera, they have some cash they can lend, but they got to protect their cash. So unfortunately, it's going to be a tough time for jumbo loans for a while and high balance, but it will come back. Just remember back in 08, this was exactly the same thing. It's not going to be good for the high end, you know, prices. So focus on the stuff where you got conforming loans. There is an unlimited amount of conforming business out there. Oh, let me unshare.
Yeah. So Dan, real quick clarifying question. So So you feel the high end of real estate could get hurt more than the low end. Is that what I heard?
Yeah, if you can't get a loan, then you can't buy, and sellers are going to start panicking, and they're going to start dropping their prices too fast, not realizing it doesn't matter. It's financing. It's not about dropping your price.
So a video I want to push everybody to watch and listen to. It was with Larry Kendall, the author of Ninja Selling, who, you know, I could do a whole, I mean, brilliant guy, but he talked about the dual market. And so we will absolutely see a dual market in most local markets where lower end homes that, you know, are getting conventional and Fannie Freddie financing will have one reality, and jumbo homes will have another reality. So that will present opportunities. We'll cover that in future calls. But if you don't know what a dual market is, it's time to get smart on that. Go to the Mortgage Coach YouTube channel. You can either type in dual market, Larry Kendall, and we'll start educating on that in future calls. Scott, any questions you have for Dan before we start getting into marketing advice?
Well, no, not questions, more of just feedback. I mean, there's a couple. Like,
Give feedback. Give them some feedback.
Like pull your rent versus own up, if you could. I don't know, Dan. Well, let's say. No. Give Dan a minute. Dan, if you could pull that up. By the way, Dan, people are asking for the slides. Do you mind sharing the slides in the group after this call?
Of course not.
So guys, we'll take Dan's slides. We will put them in the file section of our Facebook group. So just a reminder to everybody, I mean, that is just a gold mine, a vault of content, of slides, of images. These slides will be in there. If there's some slides that we don't have that you want, let us know. Steve Harty in Keeping Current Matters is also bringing in a lot of great content and slides to help provide clarity around real estate. So stay tuned for future interviews that I'll be doing with the Keeping Current Matters group and the content. Check out the vault. So Dan, you want to show that slide for Scott real quick? I'll tell you what.
Which slide?
Just your rent versus own. If you still.
Oh, sure. Yep.
Oh, the rent versus own TCA.
Yeah.
Oh, the TCA. Okay, let's see here.
Yeah.
I think I got it back.
So three things I wanted to comment while he's pulling it up. Number one, think of what Dan just said. I don't build these things, and he just put it together real quick. So they're super easy to use. So there's really no excuse there. If Dan can put it together, anyone can put it together, right?
That's right.
Agreed.
Yeah.
Number two is there's a really powerful part of that TCA, and it drives emotion with that consumer, and it's almost like it's that internal hate of whenever you talk to a renter, like, I hate writing checks to my landlord and I'm paying off this mortgage. And so when you looked at that graph of how much rent that consumer paid, you know, over that time frame, I think it was like 60 months or whatever it was, to what you've done. I mean, it's that right there drives the emotion and the conviction. It's like, hell yeah, I'm in. What do I need to do to get into this housing market? So I think it's really powerful. One, they're easy to do. Number two is really draw attention to your consumer on that emotional pivot point. And then the last part of that is when I put these together, a pretty common response is like, hey, I go, Scott, that gross payment of, $2,000 or whatever it was, that's $300 or $400 I just don't have. That's a great segue to bring in the CPA of like, hey, let's bring him or her in. Let's comment what you can change and what you're claiming on your pay stubs so you can pay less taxes, keep more money internally, and at the end of the year, you can score up at the end. So you can create cash flow there, and a great way to work in that CPA advice.
Yeah, so I didn't pull up Dan's, guys, but if you go to our mortgage strategy webpage on our website, Mortgage Strategies, guys, there's never been a more important time that you position yourself as a mortgage strategist. I pulled up the Denise Donahue one. It's right here, using the rent versus own analysis. And if you go to that, not only will she, show you a couple of her total cost analysis with the rent versus own, but I interviewed her on how is she creating that content and pushing it on Facebook and Instagram. So it's scripting, it's sales strategy, and it's how to advertise rent versus own in today's market. So it's really good stuff. Scott, anything else before we move into the next chapter of today's call?
I think for everyone watching that doesn't really know Dan, or maybe Dan's come into the forefront of their lives now, which is important moving forward in these swings, is, you need to really follow him. And I'll give you a 2-second story. Is the Sunday that the Feds moved the first rate, whatever that was 3 weeks ago, that Friday, because I watched Dan. Dan and I are great friends. I work with Dan, so I follow him a lot. So I tune in. So that Friday, right before the Sunday first rate cut, I'm going, wow, this like the 10 years like a 30 or 40 basis points. This is overswung and oversold. And I know Dan was talking about that. So around 2 o'clock, the market started to move. I locked my entire pipeline that afternoon without anyone's blessings, which was a risk. And I go, I'm going in. I even locked my mom. And then I even told the story, guys. I'll tell you, just bear with me. I even locked my mom. She goes, hey, if you locked your mom, we're all in. But when you follow Dan, and I put another post up about a jump rope analogy, it's about understanding the markets well enough. You know the timing to jump in and jump out. It's about timing. And it's critical to understand timing. It's why I think Dan, what he's doing in that service, shoot, I'm going to follow him in that stuff too, that little option, or not the little trading and live update stuff. So kudos.
Market mentor.
Yeah. So guys, Dan is available every day in the Rate Watch. He's providing a commentary that's just a couple minutes long. You know, we've got a day watch. We've got, you know, the entire market. Now we have even more data from Optimal Blue. And you just heard it from Dan. He's going to make himself available in a way that scales so that he's available hourly to you through his premium platform. So let's transition. And I'm going to, you know, put Tony on the hot seat, Scott on the hot seat. Joe, I'm going to ask you to bring in questions from our community. And guys, Ben and I are going to stay here as long as you guys need us. So I want to read a post that Steve Harty posted earlier this week that really made me think. And his post on Facebook was geared to realtors, but he said, top of mind marketing, I fully agree it works. And he's just talking about how to build a personal brand in marketing. And then space. If you post about cherry pie recipes, they'll think of you as a good baker. Space. If you post funny memes, they'll think of you as a comedian. Space. If you post about relevant real estate information, they'll think of you as a real estate expert. So we need to be thoughtful. There's never been a time where people are getting more screen time. There's never been a time where people are competing for leadership in the marketplace. And so my push to everybody in the mortgage coach community, what's your mortgage brand? Who do you want to be thought of as a mortgage professional? Do you want to be thought of as an economist? Do you want to be thought of as a loan officer? Do you want to be thought of as a mortgage advisor? What's your brand? And then how are you showing up with content? There's no doubt to be a mortgage advisor, you need to be thoughtful about economic data. You need to show up as, we call it, a market leader. That's why we built Rate Watch. We think you need to be a market leader. But you know what? We built the total cost analysis first because you need to be a mortgage advisor. So I just want everybody to think like all of the content you're creating, what are you creating and how are you creating? So Dan, I'm going to go with you first on this. You create these daily updates, you create this update. What do you think loan officers should be doing? How should they be taking that and then being marketers to build personal brands? What do you think they should be doing? And what's too much? You know, like, what are some things where you think like, you know what, guys, you're being an economist now, and that's not how you make a living. So give us some of your narrative around that.
So that's a really good question. I'll tell you, back in 1989, I launched RPM Mortgage, and I had just come from Wall Street, from my bond trading career. I just got burnt out on the whole New York scene, and I opened a mortgage company. I hadn't originated a loan since I graduated, 82, I guess, or 81. So I didn't know what to do. And I leased this big old office. I had fancy desks, and then I realized there's nobody here. I don't know what to do. So I came up with this marketing scheme. It's really cheesy. I don't know that I would do it again, but the idea behind it was really solid. And it was me, my fancy 30-year-old self or 35-year-old self leaning against a black lacquer desk in a black suit. And the headline was from Wall Street to Main Street, Dan knows. And it was basically, if you really want to know what's going on with interest rates, if you really want to know what's going on with mortgage market and when you should act, I'm your guy. And back then, borrowers came into our office And the first thing that I did is, we didn't have the internet. God, I feel so old talking this way. I had a Bloomberg terminal, and I remember Rob Hurt, my partner, was like, God, this thing's expensive. Do we really need it? But the Bloomberg terminal helped me recruit every single LO, because I walked people over to it. I showed them what I was looking at. I explained the yield curve. I wasn't trying to teach them. I was just trying to show them that I do get it. And then loan officers fell in love with it. They came to work for us. Before we know it, we had a full office. And every borrower I ever talked to, I honestly, I got the deal. If they came in my office, I got them, because they just felt this comfort level that I had my finger on the financial pulse. So I don't know where too much is, unless you are trying to dominate them with your opinions. I would never do that. I would always say, what do you think is going to happen? And they would say, I don't know. I'm not an economist. I go, well, most economists don't know either. I'm curious about your opinion. And when they tell you, I think things are going to get better, I'd say, well, I do too. Why don't we take an adjustable rate loan? Now, again, I don't know. The yield curve is so flat, there's probably zero benefit to adjustable rate loans. So then maybe it's a no cost loan. But I would always take what they think, and I would develop the product around it. So in terms of, so that was that one question. I don't know that you could be too much unless you're being too forceful with your opinion. No one wants to do business with a know-it-all. Validate them when you can. And if you don't agree with them, just say, I have a slightly different idea, but it certainly could go that way, because it could. And then in terms of what should you do on a daily basis, it made me think
Weekly
that
basis,
I
weekly, daily, monthly.
Yeah, I need to come up with a better way to make my content shareable to all of you. So I think I think in terms of just maybe doing this live, you know what you could do? If you have a good screen tool, when I'm showing a graph, just screenshot it. And then make a couple notes of what I just said. It takes 2 seconds to make a video. There's so many incredible video tools right now, like Loom, Loom interfaces with Slack. I would get all your customers on Slack. I'd have a Slack channel for different customers, and Loom integrates and just, hey, here's what's happening today. Here's a couple slides. That's what I would be doing. I would, and I don't think you could do too much. This happened by accident, Dave. I mean, when you asked me to do this, it was 2008. I just wanted to help. I wasn't looking for fame or fortune. I liked you, and I liked the concept of what you're doing with Rate Watch. I wanted to help. And who knew that 12 years later, all this content would lead me to what I do today. And even today, every day I do Facebook Live. I don't care if anybody buys anything. The more you give to people, ultimately you do become known as the expert. And it's almost uncomfortable sometimes, because I'm doing so much content. People come to me, they sign up for my classes, and it's like they put me on a pedestal, and it's very awkward. I don't like it, because Dave, you know me. I'm like, I'm just a guy. It's like, I don't say so many good things about me. It makes me uncomfortable. The sky's always falling. Something bad's always going to happen to me. It's just so, but the point there is, when you give and you give and you give, and people see you on video, they begin to think of you as like a micro celebrity. So I think this content could get you there.
All right, man, that was great. So Tony, I'm going to come to you next with a very similar question. Before I do that, I want to give some leadership to the mortgage coach community. I interviewed Bill Hillstad a few days ago, multiple times. And I will tell you guys, you should be doing interviews with local leaders and promoting them the way Bill Hillstad teaches you to on Facebook and to your database. You absolutely have to do that. You should be absolutely listening to Dan every day in the Rate Watch channel. And should you be posting and be an economist every day? Probably not. But should you be doing something every week? Absolutely. And make it tailored. I love what Dan said, take a screenshot and then put your context and your color around. You should absolutely be doing that. But guys, here's what else you're not doing enough of. And you can take a page from Denise Donahue. You should be a mortgage advisor. You should be doing mortgage makeovers, where a family came into me, they thought this, I showed them this, show a little screenshot of TCA, or you post a link, and you're a mortgage advisor. So those are the 3 pieces of content, guys: interviews, market content, and mortgage makeovers, where a family came to you and you gave them clarity and confidence. And those are the things. And there's more, but those are the 3 cornerstones. If you want to have a brand other than a loan officer, you want to be a mortgage advisor, you need to be doing those 3 things. So one last thing, Dan, I love you, brother. But and anybody out there that is building, Slack channels, I want to hear about it. But that is a little, maybe that's a great idea. Here's what you should do, guys.
Okay,
You should have Facebook groups. Facebook groups. Facebook groups for your realtors. Facebook. Maybe Slack's a good idea. I'll wait for someone else to tell us if that's a great idea or not. So Tony, I bring this question to you because you are just a tremendous. Tony, when he was a producer, he's done over 1,000 TCAs. So even though he's a regional leader now in the Northwest, he leads loan officers. He's done 1,000 TCAs. You've heard this update. You already create some of this content. What do you think loan officers should be doing today from a thought leadership perspective?
Yeah, thanks, Dave. Well, I think about how I coach younger loan officers that are newer in the business. I mean, there's a lot of huge producers on this channel, but there's also a lot of people who've gotten in the industry in the last couple of years. And what I remind them is that, perhaps up until this point, your Facebook community or however it is that you market yourself socially, a lot of them think of you of how they knew you in the past. Maybe it's, how you were in college or, what you were doing before you got into the mortgage space. And I really believe that it's times like this where all of a sudden we have the general public and the news and everybody else is talking about what's going on in our industry, whether it be this idea around forbearances and what the heck is going on there, whether it be about interest rates and the Fed and this, the economy and housing. I mean, gosh, we could not be in a better environment to have a spotlight put on our industry. And I really feel like for so many people out there who maybe haven't been out in front of their sphere, if you will, now is the time to do it. And you can position yourself to everyone as an expert in this space and really create your brand in a very short period of time, because so many eyeballs and so many people are starving for the information that you have right now. And so I think that I just can't emphasize enough how important timing is. I think consistency is critical too, but don't miss the fact that right now, like literally right now, is the opportunity to get out there. And, I haven't always done a great job, but I'll just speak to what I'm doing really briefly because I've had a lot of people reach out to me. I just have done a couple simple videos. I'm doing about one a week, trying to, get content out. When rates were all over the place, I started around the Fed rate cut and what was going on with interest rates. And so I wanted to show the rate watch graph. And I just use iMovie right on my iPhone. I take the video with my iPhone 11. I go to iMovie. I import it in. It's really easy there just to split that out. I put at the footer, I put my name, my NMLS number, my company name, so that I have my compliance piece in there. And then I'm able to just embed a picture-in-picture, bring up the Rate Watch app or a screenshot of it. I can even take a screenshot on my iPhone, do some annotations on the graph, and then just save that and embed that in my video and speak to it for a couple minutes and push that out. And that's just super simple. It takes literally a couple minutes, to Dan's point, and you're creating content with some graphs, with some visuals, with some information. And now's the time to really leverage the fact there's so many eyeballs looking at our industry to really catapult yourself in that space. So please don't miss that opportunity to do it right now. And those are kind of my thoughts on the market. And I would say this: every single morning, you need to get up and listen to Dan's commentary. I've said this to you, Dave, when we've worked together, is that just listening in every day, you don't have to study this stuff necessarily, because if you just open up your Facebook or in the app and listen to Dan's content, over time, it's just going to drip on you, and you will build up a level of knowledge that exceeds most people in this space, just simply by tuning in, paying attention, and letting it over time educate you. You will move up the ranks, if you will, just simply by listening.
So guys, all the questions that have come in through Zoom and Facebook, after Scott goes, I will make sure we get all your questions answered. I did just put a link to the Bill Hillstad video. If you want to be the most well-known realtor or loan officer in your city, you have to listen to this. I mean, pure gold, because they talk, at a high level of what type of content should you create, but at a tactical level, how to promote it on Facebook in a way that builds that brand. And Bill makes the case, literally within 6 weeks, you could go from, you know, I'm not well known, I don't have a personal brand, I don't have an audience, to literally building a brand, getting 50,000 plus views of your video. He just gives you a very tactical, specific way to do it. So that's a must-watch interview for the mortgage coach community. I just put it in comments. Check it out if you haven't already seen it. So Tony, 2 favors, brother. So first of all, thank you for all the time you invest in the community. I would love it if, one, you would take one of your market updates that you just described and push it into the group so that it's at the top of the feed right now. Are you cool with that?
Absolutely.
And then 2, you do such a great job of taking Dan's nerdy content, and then you've become kind of a nerd yourself with Dan, and I know you're in his group and you subscribe to everything he does. But we have been getting a lot of people asking us, like, hey, how do I use RateWatch in this market? Like, it drives Joe and I crazy. We're like, you mean everybody in the mortgage industry doesn't know RateWatch and they don't have it downloaded? Are you kidding me? So would you mind creating a video, and you don't have to commit to a time, where it's like Tony Blodgett on how to use the RateWatch app and platform for loan officers, and I would share it. Would you mind putting that on your list of things to do one of these days?
I will work on the best way to create that for you, Dave. Absolutely.
Right on, dude. This is what makes the mortgage coach community awesome, guys. We have the industry's most valuable loan officers to families, and we're just helping each other out. So Scott, speedball, your turn. What are some things people should do to build their brand, market the fact that they're a mortgage advisor in today's market?
Yeah, I think I'm gonna go a little bit further with this. So let's say we've checked the box with Dan. So one, just every morning, like Tony said, check in with Dan and just build knowledge or continue to build knowledge. But I think the key is when you're doing that, you have to learn to communicate at a different level. Like Roberto taught us way back when in our class. When Roberto is moved down that ladder of how they were going to receive your message. So I think it's critical. And I want to show a couple things. So I'm going to share my screen. So I think.
So by the way, while he's sharing his screen, just remember, everybody, it's going to be a few more minutes because, like Dan said at the beginning, Scott could go, man. So let's. But I didn't say that. I didn't say that to slow you down, bro. We want to get the whole Scott Nicholson rundown, brother.
Right. So here's a couple things on how you share that content. So there, I took the RateWatch and the movements and I posted it on there, and I made the analogy of the jump rope about it's important that I understand the market, but what I'm going to help you with is to jump in the market, right? So taking these little screenshots here, and we have these big movements. What does this all mean? So laying it out to the people that follow you. Trust me, every time I did this, I automatically get those little instant messages popping up like, hey, we need to talk, Scott. We need to do this. Maybe look at a refi, da-da-da-da-da. They're like instant. Like you're fishing and you're instantly getting them in there. But I think even bigger picture, here's where I want to maybe add my advice here, bigger picture. And like I said it a little bit here, when we go to the end of this market, that consumer is going to come in with more debt, that consumer is going to come in with lower FICO scores, and that consumer is going to have less assets. And so a lot of people aren't talking about that. So you have to take that, what the Joe coming into the market, what he's going to look like leaving this virus crisis and ready to buy a house, and think of a conforming loan. The rates are perfect. Just imagine pricing one out where he was at 6,760, he's going to be at 690. I mean, those loan level price adjustments are massive. So he's going to be coming in to going, 4 1/8? I thought the market was at 3 1/4. So I put these little simple presentations together for my agents. So I'm teaching classes now. You should make these, and I'll share these. This is the average Joe coming. Row 1 was coming into the market. Row 2 is what he's going to get. Row 3 is me structuring in the seller buy down to get him actually below market, even with a 703 middle FICO score. And then row 4 is saying, if I took the seller buy down away, and you just didn't do anything, you went to Joe Lender and he's a big buy, whatever he or she's going to do, you're going to have to decrease your pre-approval, right, by $63,000 to get a house. And then one of the things with jumbo, I know this was a hot topic here I'll open this one. This one actually set a record last night. So I have a client looking to buy in Marietta, California. He's got a jumbo property. He doesn't have much money, so I put this presentation together last night. I got a jumbo 15% down at 5 1/8. You think he's falling in love with that, especially at that price at $63.36? I structured with a 19,000 seller buy down, took it to 3 3/8, and it's like buying the property payment wise. If you look at 2 and 3, it's like buying the property for 170,000 less. This is the information you have to bring to your agents, right? You sit down and go, listing agents, the buyer coming to you when you're reopening for business is going to be different. And you're going to have to deal with that client, and price reductions aren't going to help. And this is so I'll give you another example. Go find Ryan Grant. Go look on his page from yesterday. I sat with Ryan yesterday. He did a Facebook Live. We did he invited me because, Scott, I need your help. Or I'm doing it to all my agents, my financial planners, my LOs, and my direct consumers. I need you to teach this stuff to my people. And so go to that 1 hour live Zoom on his Facebook page, and I'll show you all the details on this. This is the stuff that's great what Dan is teaching us. You need to know it, but you need to jump ahead and give true value to a dented client that's about to re-enter this market. Did I stop too soon? Did I freak everyone out?
No, you were great, bro. So, by the way,
one more thing. This is more relevant. I'm sorry. Oh shoot. This is a really important one. Got to purchase. Think of this, Tony. And Tony's really good at this. I think he said this earlier. We were put our offer in. There's 10 offers into it. I did my TCA. Monday, I'm at 3 1/4. The very next day, I'm at 5 1/8. On Thursday, 3 days later, I'm 4 1/8. So I quoted her a 3, a 5, and a 4. How do you think that buyer felt? Freaked out. She was going to leave the market. And so I'm thinking, wait a second. So I structured a small seller buy down in there and I structured it as an insurance policy for her. So if rates spiked again, I can implement that and buy it down. So when the listing agent called me on those 10 offers, she goes, Scott, okay, we're going to talk about your client. And she did the normal Q&A. Okay, great. And I go, you're asking the wrong questions. Number one, I don't care if we're putting 50 and an 800 FICO. You need to ask the question what my client does. She works for public infrastructure. We're going to be there on day 30 for you. Number two, your concern of the 6,000, how I structured it, it's not for closing costs, and it's an insurance policy that I'm going to protect her because we've been sitting here for a week waiting for you to accept our offer. And how I structured it, how she loved it, the listing agent, and by the way, I went after her, and how I sold her on the income portion, we're going to be there, we got the offer accepted. That's how you'll have to fight for your deals, especially purchase moving forward.
So Scott, you're killing it, bro. And I love the community that you're building within the Mortgage Coach. If anybody wants to follow you or learn, follow you more to learn all this stuff, where do they go?
I can hold, if everyone wants, I can hold just a separate, a great one is go to Ryan's page and go look at, that's exactly, you get everything alive in whatever we did yesterday.
Well, how about sharing that in the group? Would you mind taking something, putting it at the top that anybody wants to learn these strategies, connect with Scott, learn more about what he's doing, check that out. Yep. So I'm going to take the screen and then we're going to do community questions and we're going to wrap it up. About once a year, this call goes long. So for those of you that this is the first time you've been on this call, we never, literally 1 minute over the hour. But these are extraordinary times. I think it's an extraordinary time for us to go a little longer with the content. So takeaways for everybody. You need to teach every family that you talk to something they hadn't considered. This is part of our black belt training. And then as a mortgage coach professional, you want to teach them something in a way that they will always remember it. That's what a mortgage coach is all about. And pulling from a quote that's one of my favorite quotes in the interviews I've done in the past, month, came from Josh Metal, where he said, mortgage strategy always trumps rate, 10 out of 10 times. And then he shows a TCA to show that. Guys, this is the path to winning. And guys, here are the 4 essentials to making a smart mortgage. And you need to make sure that you're teaching every single borrower these 4 fundamentals. We need to start looking at cash reserves beyond just what cash reserves are to qualify. It's like, hey, do you have enough reserves for an emergency like the one we're in now? Do you have enough for the opportunity like the stock market that's coming? Number 2, you need to analyze the cost of debt over time. It makes every other loan officer that's giving a fee worksheet look like they're the villain. They're holding something back. They're not transparent. These are the 4 fundamentals. Cost over time. You need to look at consumer debt. Even if it's a purchase, you're doing a purchase for someone, you need to look at what's your total debt, car loan, student loans. You need to look at that every time. And then of course, number 4, you need to always show strategies to prepay the mortgage or reduce the cost and become debt-free faster. So if you're doing refis in today's market, this is just a great example from Jeremy Forcier, where he provides the TCA, the transactional triangle, as we call it, in our Mortgage Coach Black Belt training. You always show the advice star, cost over time, how to pay off the mortgage faster. And guys, this is where it really breaks down. This is where you create that star moment. When you show a family like, hey, here's program A, your loan, program B, the refi, program 3, what if you prepaid that $265? Guys, that's where you create the star moment, is doing those things. And that's what it's all about in today's market. Build brands. Like these slides I'm showing you right now, you should be taking some of your TCAs, creating content like this, telling stories like this, putting a link to the Mortgage Coach TCA in comments, and showing them how you're a mortgage advisor. This is another resource, guys. It's in our group. It was just launched this week, where we're creating more and more content so that you're teaching your consumers how to read the TCA, reminding them that, hey, you could translate this into Spanish. You can share this with your friends. It's got the summary of data and all the information. By the way, guys, what you're seeing right now, it's in our Facebook group. You could go download this. You could create a GIF and promote it on Facebook, showing people that you go beyond the transaction. You help people make decisions that help them create wealth faster. And of course, if you follow Dan Rawitch, he's going to teach you strategies so that you can, buy stocks, be more efficient. One last thing, and then we're going to do Q&A. I just want to remind you guys, every day of the week, we're training you. If you're new to Mortgage Coach and you're a white belt and you've done less than 20 TCAs, Monday, live training. If you want to become a black belt and you want to learn all the strategies, Wednesday, live training. If you just want to go to the Mortgage Coach Genius Bar, it's like going to the Apple Genius Bar that we can't go to right now. Every single
Dan,
I don't know. I think we might have lost Dave.
Yeah.
Dave, yeah, I lost you. Would you ask me something? Oh,
Maybe, hey, Joe, can you ask some of the questions for Dan?
Yeah, for sure. So there are a couple of questions that came in, Dan. So one of them came from Greg, and ultimately they're just saying, when you're looking at what we've got and you're looking at an environment fraught with EPO risk, are you all selling BPC and buying it down to a point so you and the borrower are bulletproof, or is there a different strategy that's being followed? That's, again, a post from Greg.
is that for me? Because it sounds like more like a loan officer question. Maybe I'm misunderstanding it.
Not too sure. Not too sure. They didn't direct it to the panel. I don't know if any have any comments on it.
So, I thought of something, and this might sort of answer the question, but I thought of, back in the day, the first question always is, what's your rate? And my answer always was, if I'm the first person you've asked that question to, well, that's good, because I'm going to give you the truth. If you've asked anybody else that question and they answered you right off the bat, you should be very suspicious. And what do you mean by that? Because how can anybody quote you a rate until they know more about your situation? Can I ask you a few questions? You control everything with questions. So, okay, sure. What do you want to know? Well, how long do you plan on being in the house? How many kids do you have? 2. Okay, do you think you're going to have a third because you have a 3-bedroom house? So maybe you're not going to be in the house 10 years. And you start talking to them about their life, and then you synthesize the data and you feed it back, and you say, based on what you're telling me, you're going to be in the house for probably 8 or 9 years until the kids get into college. I think we should take this 30-year fix, and I think we should pay a couple of points because it's going to buy down your rate. Because you can't just tell them until you understand their situation. And that's what I've always loved about Mortgage Coach. When Dave came out with it, I was kind of annoyed. I didn't know him. This was years ago. I was doing this data on a spreadsheet. I would ask those questions. How long are you going to be in the house? How many kids do you have? What are your plans for putting the kids through college? When do you want to retire? Take all that data, feed it back to them with the perfect loan, and then I would put the loan side by side on a spreadsheet. Then Dave came out with Mortgage Coach, and boom, there went my advantage. But turns out, still, with all the loan officers in the world, not enough of them use Mortgage Coach. So anyway, I don't know if that helps or not.
I think that's tremendously helpful, Dan. I think it's always a good reminder of how to best package advice. Tony, Scott, any extra comments to Greg's question, or I'll bring up some more?
Yeah, I mean, sorry, Tony, go ahead.
No, I was just going to say that, well, I think it depends on where it is exactly you're getting your rates. And so I think there definitely is some par rates out there. If you're a broker and you have access to multiple different lenders, I would be looking at all the different lenders that are available. If you work for a mortgage banking company, I think some are in, some are out. And so as far as discount points go, I think a lot of people are seeing a rate that requires discount points. Just, you know, there's not a higher rate on their rate sheet. Or they're, to this question, strategically saying, hey, there's a possibility this thing could EPO and there's going to be a lot of expense. So I'm going to charge for that and lower the risk of this being an EPO by charging up front. Regardless of the situation, I think that Dan's point is valid, which is for a lot of people, paying a point does make sense. And I think that we've been in this situation for the last decade where once LO comp changed in 2010, everyone stopped charging origination fees. Everything was flat. All we have is like this little lender fee that ranges between, you know, $500 and $1,500 in most cases. And that's all we're used to paying. And we all forgot that before that, it was standard to have an origination fee. It was standard to even pay a little bit more. And if you go back even another decade, it was standard to have an FHA rate start with 2.5 points, and there was no other options. And so, you know, what's old is new again. And I think that we just need to remember that this last decade, we haven't been charging origination fees or discount points. We're not used to it. And I think this is where a tool like Mortgage Coach is more relevant than ever, because you got to look at the rate that is the most affordable rate and then plug in what the cost is going to be, spread it out over time, and then be able to articulate to your borrower what the actual cost of getting this mortgage is. It's never been more relevant. And I guess it doesn't really matter. There's a lot of end fighting right now about whose rates are what and if you're paying points or not. It doesn't really matter what you're seeing on your rate sheet today necessarily. It matters on how you can present the data to your borrower and get them to understand, and forget the idea that every loan should have no cost up front to your borrower, because that's just, and you've heard that ad nauseum on this call, but it's so important to remember that we just have not experienced this in the last decade. But for so many years before that, discount points were part of the conversation.
I agree.
So guys, we've got a long time to say about my technical glitch. Joe, are there any other questions from the community that we want to make sure we get answered before we wrap this up?
Maybe the last one, just from Rick. He mentioned how everyone takes into account consumer confidence. And when you're looking at the interpretation of different measurements of consumer confidence, and you look at how things were in 2006 and how things you look today with things like shelter in place orders, et cetera, how you would use that insight in conversations now, specifically the consumer confidence.
Dan.
So I use consumer confidence for a lot of my analysis constantly. And one tip, there's a website called morningconsult.com. Every single day they're doing consumer confidence studies, and you know, how are people making 60,000 to 80,000 feeling about the virus? All these different economic questions. Their data is unbelievable, and it's free. So consumer confidence is the number one leading indicator out there until it's not. Because what I talked about earlier was consumer sentiment, the optics index, when people are feeling too good. When people are feeling too good, there's only one way to go. And consumer confidence reached a high that we hadn't seen since 2007. That's kind of when I knew this was about to end. So, but until that happens, on the way up, you can kind of guess that the economy is going to be doing better. Home prices are probably going to go up and rates are going to go down. Right now it's plummeting. So, you know, that's going to lead to much lower rates and maybe some pressure on home prices.
Guys, I put a link to what Dan mentioned in chat. It's both in the recording and the YouTube channel, or the Facebook group, and in Zoom. Joe, any other questions?
No, that'll do it from the Facebook list. Thanks, Dave.
All right, guys. So we obviously shared a lot. It was a fire hose. This is available in our YouTube channel. If you got value from this conversation, you know, let us know down below. Give us a like. If you loved it, give it a love. I do believe there was so much wisdom shared today that this is something you might want to listen to again. There may be parts of it that you want to share at a sales meeting, even have a portion of this or all of this that you share with your team. Dan, I'm going to give you the closing thoughts on today's call. Any last words of wisdom for the mortgage coach community as we wrap up today's call?
You know, just stay positive. We've been through this. How you feel inside is 100% psychically transmitted to your borrower. Even if they can't see you, there's a slight change in your voice. You have to feel good about what's going on. I know it's hard right now. You got to see through the other side. You got to realize that you are the source to help people get through to the other side. I don't care if a guy's making $1 million a year. They're looking for leadership right now. They're all confused. So you really have an opportunity to take all this data and say, it's going to be okay. Maybe that's a little woo-woo, but that's how I feel right now. We've got to stay positive because we're going to get through this and we're going to be stronger than ever.
Yeah, no, that's great words of wisdom, man. And my closing thought on this is, you know, something I opened the call around. We are so blessed to be in the mortgage business. We have jobs, and we not only have jobs, we have jobs where we can have record-breaking success. And we also have a job that can create fiscal stimulus for America by doing efficient and effective refinances. It's time for us to be our best. But what Scott Nicholson shared, you know, you want to work on getting inside. It's like, be your best at your work, and then be your best at how you're serving the community. Make sure you look at that post from Scott at the top and some of the ways that he's serving his local community, helping his neighbors, you know, just any way that you can creatively help people. And that doesn't mean writing big checks. It might be writing big checks. It might make, when you do, if you're ordering to-go food or you're getting food at restaurants, giving big tips, helping our local businesses survive and make it through this. But I want you guys to close out with, you know, between now and the next time we talk about Mortgage Coach, you know, to feel good inside, you got to be helping beyond yourself and help your neighborhood. So guys, be strong, be safe, and stay inspired. This call is a wrap. Take care, everybody.
Thanks. Bye.